everyone, you guys want to come up for the next panel about buy now, pay later. Probably one of the most lightning rod topics right now in the media, just from a public relations standpoint. We've been working with our clients a lot on this area. So definitely looking forward to this particular panel. Oh, yeah, go ahead. It's a good idea.
Good afternoon, everyone. BNPL has been a buy now, pay later has been a hot topic for us. We cover payments, and I suspect we've been doing BNPL stories just about every week ever since, at least since the pandemic started. So we thought it was time to investigate this a little further, and this panel is a great opportunity to do it. We have some great experts here. I think I might let them introduce themselves, starting, Darren, with you, and then moving to your left.
Thanks, John. Hey, I'm Darren Beyer. I'm a co-founder and Chief Product and Strategy Officer for Colo. Colo is an omni-channel payments provider, so we do issuing, processing, and all different forms of payments on one platform. And we service some folks in the BNPL space, but we're sort of a back-end, behind-the-scenes provider.
Thanks, John. Tim Harris with FuturePay. We have a platform, digital revolving credit platform called MyTab, which we just launched yesterday, as a matter of fact, after 2 years. And we are a hybrid between BNPL and credit card programs. So, like BNPL, we offer financing in the shopping cart of major e-commerce platforms like Shopify, Magento, and so forth, for e-commerce transactions. But unlike BNPL, we are a revolving credit provider. So rather than financing a single transaction with an installment loan, we are a revolving credit offering we offer between a $1,000 and $5,000 line to our customers that they can use perpetually, much like a credit card program.
Great. My name's Ryan Tuttle. I am kind of the odd man out here in that I work for a market research firm, not directly in the buy now, pay later space, but we do, it's a Euromonitor International, it's a global market research firm, and we look at a variety of different industries, payments included, across a pretty large global swath of countries. So that's the space that I research is payments and work in tandem with our associated service industries such as travel and food service and retailing.
All right, thanks so much. Gentlemen, we have a lot to cover here, but just to level set a little bit, I don't know about the audience. I was, as I mentioned earlier, I cover payments. I was still surprised to see what buy now, pay later has done. Just a few numbers there's a bunch of numbers floating around, but in 2019, there was maybe $33 billion in volume worldwide. That by 2021 had climbed to $120 billion, according to these figures from global data. That's quite a remarkable increase, attributable perhaps to some extent to the pandemic, but that's, I think, when people first started hearing widely about this option. Perhaps we should maybe get a definition on the table here. Would one of you gentlemen care to take a stab at just defining buy now, pay later and explaining how it's different from common, well-recognized layaway plans?
Yeah, I can jump in. So I think buy now, pay later it's both a really easy to define term and really not an easy to define term. I think a lot of us conventionally think of it as the kind of pay in four model, and that's certainly probably the most popular and the biggest name, and that's going to be your Klarnas, your Afterpays, et cetera. But really, buy now, pay later is it's not really anything new. I mean, we've had this around in various forms for a long time, whether it's layaway at Walmart or wherever, your local department store. And, installment billing, I think, is probably our best way of describing the buy now, pay later idea. But I think the biggest thing right now is the digitization of buy now, pay later, and seeing it come into the online space in a real significant way has been really the storyline in the past few years.
Well, how, again, just definitional, can someone take a stab at how you could distinguish between and know which to adopt in terms of offering a traditional installment loan or revolving credit or BNPL? I mean, how do you make that decision?
Well, I think buy now, pay later has been very successful for relatively low volume, or sorry, low margin, relatively low cost transactions, because by its nature, splitting something up into 4 payments only makes sense if it's paid in 4. If it's less than $1,000, for example, typically less than $500, and so installment loans in the pay in 4 space has been relatively high margin, low value, where that becomes more difficult as there, for higher ticket items like bicycles, for example, that are more expensive. The pay in 4 model doesn't really work that well, so a lot of the traditional BNPL vendors have spread those installment loans out over a longer time horizon beyond pay in 4. But in terms of the revolving credit makes a lot more sense for things that are purchased on a recurring basis. So if you think of things like sporting goods, pet supplies, things of that nature that people buy on a repeated basis, it doesn't make sense every time to open a new installment loan when revolving credit is available as an open line of credit.
Yeah, I think if I could just add, I think there's a lot of it is around the use case and how they've been traditionally used and how they've been traditionally defined. I think traditions are starting to go by the wayside. I think we're starting to get some changes here, but I would say traditionally installment loans have been merchant specific. I think if you can call BNPL traditional, at this point they've been around long enough, maybe you could, is traditional BNPL players are merchant specific. Where we're starting to see a little bit of a difference, and you're seeing it on things like Chase as an example, will do this where you'll make a purchase on a revolving line of credit on your credit card, which credit cards by their nature are not merchant specific, they're ubiquitous, and they'll say, do you want to take this one purchase and turn this over into an installment loan? It's not quite buy now, pay later, but it's starting to merge the two together. I think our view on it has been, and we're seeing a lot of very interesting constructs come our way from fintechs that are out there, that is that credit is now ripe for revolution. I think that the neobanking space, Chime introduced early direct deposit, 2-day early direct deposit, and everything blew up, right? Everything sort of changed and everybody wanted to come up with a new neobank. Credit has been essentially the same for probably half a century. Since the first Bank Americard came out, the first Diners Club card came out, there have been essentially the same. Now what we're seeing is some shifts in that, and I think as you mentioned, BNPL that an Affirm or somebody else is doing is very similar to layaway. There's not a whole lot of difference, and that's all been very merchant specific. What we're seeing now, again, is this more ubiquitous issuing side, where you have a pot of money that can be used across multiple merchants. And then how you break that up, whether it's installment, revolving line, et cetera, is really more of a product construct. We're seeing folks that are merging these all together. So it's an interesting time. I think we're going to start to see as number one, the regulatory environment starts to iron itself out. And number two, the products start to get that innovation kicking in around this. We're going to start to see some interesting new and different types of constructs out there.
If I can jump in just real quick,
Sure.
I think there's also a pretty big audience consumer component of it too. With buy now, pay later, we've historically had it in cell phone purchases. Maybe it wasn't called buy now, pay later, but it got put into your contract, and then eventually got unbundled from your contract, and now they're finally getting to the stage where they're more explicitly calling it out as a buy now, pay later. So that's where a lot of people probably had their first experience with it, but there's all kinds of different demographics that are approaching this in very different ways. You have, closer to the poverty line individuals who are using it in the place of a payday loan, which in my eyes is it's pretty big improvement over payday lender. You have individuals, Gen Y, Gen Z, that may be kind of not interested in the potential debt trap of a credit card, so they've long eschewed credit, but they're seeing this as a more friendly option, where the penalties themselves tend to be less severe in their eyes at the very least. We've definitely seen a lot of individuals who didn't have credit cards adopting this payment method. Now we're also starting to see it in more elderly and affluent consumers who are, kind of taking the natural extension of buying a phone on a contract and instead buying a computer on a contract, or even stretching into things like home makeover kind of work, home improvement work, travel, where those are starting to eke into larger ticket items of people that probably have the means to make it, but if the free financing is out there, why not take that opportunity?
Yeah, I mean, as an example, my wife and I, we had the same mattress. I don't want to tell you how many years, but we had the same mattress forever. Finally, it was time to get a new mattress, and we went down to the local place, and we went in there. We weren't expecting to do a buy now, pay later, but the guy goes, "It's free. There's no additional interest. There's no additional cost, and it's easy. Just do this and you're done." Is it easier than pulling out a credit card? No, it was a little bit more than that, but it was easy enough that it made no sense. Why would you, if we're getting free money, why would you not take the free money and pay it back over time? It just makes, logical financial sense to do that. So I think it is cutting across all demographics now.
Yeah.
But that's still an installment loan for something you don't buy all that often. And someone's paying the interest on it, just not you.
Right.
It's in lieu of a discount
Someone
that
always
they're
pays.
offering you that financing.
To that point, though, there are a lot of individuals that never had access to that, whether they don't have a credit score, their credit score is poor. The underwriting standards for a lot of these loans are a lot simpler, a lot easier to reach, and that does kind of democratize that access to some of those benefits that they might not otherwise have had.
With the one caveat being that if they aren't doing proper credit scoring and vetting of those consumers, they can get into trouble.
Yes, for sure.
So, yeah.
So is BNPL eating into the credit card business? Is it taking some share away from plastic?
Maybe not really in our numbers that we're seeing, at least at the moment. I think where it has the greatest risk for cannibalization is store cards. Store cards have traditionally kind of met that same use with the relationships that a lot of merchants are getting into with whether it's third-party BNPL providers or the platforms that they're on, whether it's Shopify or another site. Those relationships are starting to take that position, and I think the only thing that's really missing is the loyalty component before you've, to some degree, neutralized that store card business model with one that doesn't have the same kind of debt concerns and challenges that you run into with a store card.
Well, regulators seem to be paying a little more attention to the business as well. We've heard from the CFPB, Consumer Financial Protection Bureau. What are the risks there, if any, and how serious is that prospect?
Yeah, this ties into the previous panel session on EWA, and I've got a pretty significant background there. Was with one of the EWA providers. The same basic premise applies to both of these, which is you can only take so much money before you get in trouble, right? So you can only borrow so much. And I think one of the biggest issues in the industry around this is without having a traditional I'll take the word traditional out, without having a centralized credit, I don't want to call it reporting, but a credit management mechanism where you can say how deep is an individual consumer in. You run into this problem where I got X amount here, Y amount here, Z amount here, and I've done EWA, and I've done maybe some other kind of loan somewhere else. They're not tied together. There is nothing that indicates how much exposure an individual has and will they get into trouble. This is a problem across EWA. This is a problem across BNPL, and this is, one of the things that the CFPB is looking at, right?
Yeah.
Is how do you protect consumers from themselves? Because they will get into trouble, and then that's when all the bad stuff starts to happen.
I agree with that. And, as a revolving credit provider, we're held to a higher standard. So we report, for example, we do a hard credit pull. We have a pretty strict floor on the credit rating that we need for someone to be on our platform. And we report to the core file of the credit agencies. But traditionally, the other BNPL vendors have not had those restrictions, and now they are being forced by the CFPB2 report. But with the exception of Equifax, they're reporting as supplemental data. So to your point, there isn't any consistency. So it's not tied directly into their core file. So you really don't know how deep they are in how much credit exposure they have.
Yeah, and again, things like EWA, there's nothing there. So, I take $1,000 out of a paycheck, and that's pretty high for most EWA. But let's say I take $1,000 out of my paycheck. And then even if I am doing a revolving line and a BNPL that's not reporting or what have you, that's a lot of exposure that I've got as an individual that I may or may not be able to pay back, right? And there, again, no centralized reporting around any of that.
Yeah, and I think there's kind of two main strands that come out of this as well. One of which is when you're thinking about that regulation, you have to think about credit score regulating in almost I don't want to say throw out the old model because there's a lot of value to the old model, but you really have to look at it with an eye to everything that's happening, everything that is coming in the future. You've got crypto out there, you've got buy now, pay later, obviously, you've got these neobanks, you've got people that are making all kinds of other different transactions that establish a good payment history that are not being captured. And just as much as you are worried about understanding if somebody's getting in too deep, you also want to get the flip side of that and understand where are we missing opportunities to enable individuals to be responsible with credit. Because if you're not capturing those opportunities and those individuals that are responsible, you're missing out on opportunities for them to become business, to be an entrepreneur and to be able to get the access to that credit that they need. You're missing out on opportunities for them to push up social mobility, to be able to move into houses and into new higher levels of income that we are now able to enable as these APIs and all of this open banking stuff is coming in. I think that's the second pillar, is that we have so many opportunities now to start centralizing this data, even if it's outside of a regulatory framework, but to start doing it as a customer-centric approach. And to a degree, you're starting to see some of that happen. I mean, you see stuff with like Mint or Personal Capital, where you can start to pull together your bank accounts, but that's really not sufficient, especially for a lot of younger consumers that may not do much of their work in bank accounts to begin with. Like, I step foot in a branch maybe twice a year. Granted, I have a credit union as my primary banking, but if you're only looking at my banking side, you're missing so much of that, and I'm also missing so much of that opportunity to look everything together.
Well, there are two big trends that have come along within the last few months, along with the boom in BNPL, rising interest rates and rising inflation. What are the relationships between those trends and BNPL? One would think that with higher prices, BNPL might be a slightly more attractive option to the consumer. But is that the case? And also, what's the impact of higher interest rates on this, which after all is largely a consumer product?
Well, I think that the two are somewhat connected, but rising prices and rising interest rates makes the traditional pay in 4 model less attractive, because if you divide a large number by 4 and it goes up, then it's an even larger number for your 4 payments. And similarly, if you offer 0% interest to consumers and interest rates go up, that also puts pressure on the traditional pay in 4 business model, which is why a lot of the traditional BNPL vendors have now extended the time horizon, and they've gone into interest-bearing installment loans beyond the 4 payments by necessity, because eventually that model breaks when interest rise above a certain point.
Yeah.
Or merchant fees have to go up, astronomically.
Yeah.
Yeah, I think that this is a problem, right? That by and large, these more modern players in BNPL grew up during the era of free money. Doesn't mean that money, that the interest rates aren't going to go back down again. But there's not an indication anytime soon of that. And so, a lot of these business models that were there start to break apart. I mean, we've seen it in a host of different arenas across our business, where you had people that were doing things where they'd let money go out the door, and it wasn't a BNPL scenario. It was just literally it's a spend mechanism where money's going out the door, and they're getting reimbursed behind the scenes. And it may have been a week or 15 days worth of float that they had to capture. Those, all of a sudden, their business model starts to break, and BNPL is an even more significant position than that, because the time frame that you're floating those funds for is off a significantly longer period. So it is something that's going to be interesting to see how this impacts those players.
Yeah, and it's going to be a challenge. It's definitely, I think, between that and loan seasoning, going to send a few players belly up. I definitely think that there's still potential for a host of different players to be there. It's certainly something we've seen in Latin America, where buy now, pay later has been around for quite a while in a slightly different format. It's usually provided by the retailers. It hasn't been quite as digital, but when you're looking at Brazil, which I think had interest rates upwards of 400% on credit cards, it kind of filled a natural gap for individuals that didn't want to be exposed to that kind of danger. So it certainly worked in different environments beyond just the U.S. space. It's really a question of who's going to survive the probably inevitable culling of a number of the firms that are involved here.
Yeah. Well, besides inflation, I had a conversation not too long ago with a gentleman for a story we were doing on BNPL for digital transactions, and the point he was making was that, and he runs a BNPL service, that the point he was making was that they're concentrating on higher tickets, not just, as he put it, T-shirts and socks at Target, but home improvement projects. If you need a new roof on the house, or you need to pay for a major back operation that you just had, and insurance isn't covering the whole thing. That's the market of the future for BNPL in his mind. Do you agree with that? Do you see that happening? Is that a viable strategy in the market now?
I would say, that's a long-term installment loan for a large purchase that's made infrequently, and I'm sure there's a market for that. But, at the outset, I'd like to say, we discussed this before the conference, that the penetration of BNPL worldwide of e-commerce payments is less than 5%. So there's a lot of white space out there for large purchase transactions, like you just mentioned, for recurring purchase and subscription purchases. So there's a lot of space out there. I speaking personally for our company with our MyTab product, I don't see us going after financing elective surgeries or anything like that. But I'm sure there's a market for it out there.
Yeah, we've got some clients that are doing some interesting and different things, focusing on smaller ticket items. It's because if somebody needs a break, so let's just take a look at the lower income demographic. If somebody needs a break, and they don't have any, to your point, they don't have any of these infrequent large ticket items that they've got to take out an installment loan on, in the aggregate, the smaller ticket items become that, right? So they're looking at that aspect of it, again, more from the issuing side than the merchant side. I think I agree that there's always a need around those big ticket unexpected items, because that's what gets people in trouble. But there's also need for sort of this ongoing, I need a little bit to smooth my way through my income, right? And by the way, I kind of look at that type of, and I think in a large extent to the products that you're offering, Tim, is is in EWA, again, to bring back the previous session, is the opposite side of that coin. One smooths income, one smooths expense. People need that smoothing of both sides of that, or essentially something that's ubiquitous across all of it. I think what you're talking about and what your product is, is effective in doing that.
Mm-hmm. Yeah.
To that end, commercial, I think, does have a pretty large opportunity. Now, how's that going to play out is anybody's guess, but anything that can move us past our reliance on checks in commercial, our reliance on invoicing that can take months to get paid out, that can result in significant liquidity problems for small businesses, even for larger businesses, depending on the situation. As we saw with the pandemic, when the supply chains break down, things can get pretty hairy pretty quickly if you can't find ways to get that liquidity. So I think there's definitely an opportunity for Buy Now, Pay Later to be one of the tools that can help to move that forward, probably alongside a suite of different tools that's being aimed at probably primarily small businesses to start moving that invoicing out of a check system. I feel like we've been talking about this forever, but it's still a problem.
You mean factoring isn't an answer for that?
How can an online merchant choose, and what factors should he take into account, or should they take into account with respect to these various lending products? BNPL, installment loans, revolving credit, a lot of this is online. It's kind of what drove BNPL in the first place, was that so many people were going online during the pandemic. But on the merchant side, what factors should a merchant take into account, or a seller?
Well, I think every category of merchant is different. I think it depends on the nature of whether the products and services that they sell are infrequent, and for merchants that don't, it depends on the margin of the product, the frequency of purchase, and lots of other variables. For us, the merchants that rely on high customer lifetime value and customer retention and low customer acquisition costs, those are some of the drivers of their business. We think we have a good model for that, but there are others, as you mentioned, with mattress sellers. Repeat purchases are not all that important to them. They want to get new people in the door because people only buy mattresses every 5 or 10 years. So it depends on the type of merchant and frequency of the purchases and so forth.
Okay.
Yeah, and ubiquity is key, as it kind of always is. It's a little bit better in Buy Now, Pay Later because you can entice just about anybody with "this is free" and free money. But when you're looking at a checkout screen, there's only so many buttons a consumer can put up with. Particularly if one of those buttons is a Klarna or an Afterpay or something they already recognize. I think we were talking about this earlier. If your company's popping up against those on a checklist, people aren't necessarily going to know what it is. So there's a certain degree of, I almost wonder at some point if it's going to be similar to the way that we do PIN debit routing in the US, where eventually some of these factors will be competing behind the scenes for everybody to, the consumer won't even necessarily know who it is that's running a Buy Now, Pay Later, because there's just only so much consumers can put up with. If they haven't adopted Apple Pay by now, it's hard to imagine them developing enough ability to go to any random person providing it.
Well, do we have a few minutes for questions?
Yeah.
Can we open it up for?
We're right here in front.
Yeah.
Curious from any of the panel, it's been alluded to several times here about the interest the CFPB has expressed with regard to the industry, the request of information from the 5 big BNPL providers. I haven't heard anything in terms of an update. I know the deadline passed many months ago for the submission. I had heard through some channels that some of those firms were questioning the CFPB's authority to even ask for that information. I was just wondering if y'all had any background information you could share?
Yeah, I don't have any specific on that item. What I will tell you is that we've had a number of clients impacted generally by a pretty dramatic uptick in regulatory scrutiny over not just BNPL, but a wide variety of Reg E and Reg Z programs. Without naming the bank, we had a bank that we were recently talking to, a partner of ours, that said as of the time that we met with them, which was in June, they had had 46 regulatory audits so far this year, which is dramatically higher than has been the case. And if you think about what had happened is under the previous administration, CFPB, people talk about defund the police, it was defund the CFPB, right? They were, really taken down a peg. Generally, the other regulatory bodies, because it's not just them, right? The other regulatory bodies were also impacted. And now we're looking at this as not just a pendulum shift, but like the pendulum went all the way around the circle once and then shifted the other way. So there's been a significant uptick. You're seeing it tangentially. You're seeing the same sort of thing in the IRS with the new 87,000 agents. It's like it's sort of like they've been held underwater for 4 years. Now they're coming up and not just gasping for breath, but now they're ready to assert, where they feel they should be. So we're seeing this across the board, the significant regulatory scrutiny and uptick in audits, et cetera.
When it comes to timeline and thinking about the federal rulemaking process is basically designed to be slow, somewhat intentionally, so that they can get a lot of comments in there. I think if you're trying to put an eye to what should you be preparing for, you should keep an eye to Australia and to the European Union, where I think a lot of the potential frameworks for this are going to be designed in a similar way to the way that open banking has proceeded, where we saw the EU step forward pretty hard on open banking, as well as on privacy concerns, in both cases having direct impacts on companies in the US, because companies like Klarna are based in the EU. There's a lot of, it's a great place to look for these things, because I suspect they will move faster and have the controlling policies on many things long before we have everything hammered out. So that's an important place to be looking.
One last question right there. Yeah. I'm curious about the merchant calculus on this. I mean, from a consumer standpoint, it's free, so what's not to like? From a merchant standpoint, depending on how much they're paying on the discount rate to get this service, you get a new market because anybody who doesn't have a credit card or doesn't have a high enough available balance. I understand that piece. But as I understand it, the merchant fee is usually higher than it is on a credit card.
That's correct.
And merchants tend to scream like crazy about existing rates on credit cards. So then, do they really believe the card conversion is that much greater to justify paying a higher rate than one they're already unhappy with? That's the piece that's never really gotten.
That's a good question. I mean, that's exactly what made the point about higher margin products, like Peloton bicycles, for example, where it's basically a discount. So the offset is, I mean, for a firm to offer Peloton bicycles for 48 months or however many months with zero interest, someone's paying for that. So the discount is relatively high for the merchant. The discount rate is high, and there's zero interest, but the merchant bears all the responsibility for the finance charges, essentially. And that model is difficult to maintain, to sustain.
Yeah, and I think it's important to remember that there's fees for everything. I mean, they were talking about in the session before us, even if you're not going through a card network or buy now, pay later, you got a big truck full of cash showing up that you got to deal with. You got to keep track of all that cash. You got to pull a bunch of checks and take them down to the mailbox every week, and you got to wait for all of that money to go through, and waiting on money to go through costs money. So, merchants will never be satisfied, as kind of is their right. That's part of, that's part of the innovation side to help improve those things. But there will always be costs, and there always, just wait till all this instant payment stuff has to be paid for by someone, because I guarantee you in 10 years, if a grandmother is spending money to the wrong Zelle account, somebody's going to be doing a chargeback for that somehow. I can tell you who I suspect it will be, but it will be someone, because we're not going to live in a world where that consumer protection isn't given. So I think the costs are less of a long-term concern, because basically what they're going to do is compress as the industry kind of brings itself down to a number of major players, as all the entities get involved, and eventually it probably reaches somewhat parity to the card model, and then we see where it goes from there, right?
Yeah, but I would somewhat disagree. I think I think you're correct, but I think the zero interest model is going to be, at some point, is going to be broken. So you can't charge merchants 11% merchant discount and the consumer pays nothing. I mean, it doesn't make any sense. So
yeah. How it gets paid out will be, I think, the true question. How can you make it attractive to the consumer in the long run?
Yep.
All right, thank you, Darren Beyer, Tim Harris, and Ryan Tuttle.
Thanks, John.
Appreciate
Thank
it.
you.